Okay, good afternoon, everyone. Thank you so much for taking the time. As I say every single week, I want to make sure that you walk away with sales strategies, with nuggets, maximizing every minute, every second spent with us today on a Thursday afternoon. So please take down notes. I don't care if it's a notes app, loose leaf, whatever, but I want to make sure you remember these bullets. You're going to learn a lot today. I'm going to learn a lot today. I always do when Mary Reed presents. So this is going to be excellent. We also have the Q&A pane that I want to encourage all of you to use. You can expand it or minimize it. Make sure it's expanded if you have questions, comments, feedback, good, bad, and different. We want to hear from all of you, okay? What we're going to do when you fire away with questions, we're going to answer back as soon as possible. And for anything that we need Mary for, we will wait until the end, and then I will ask your question live at the end. And then if we're running short on time, what we'll do is any questions we didn't get to, we will call you as soon as we are done. And if we need to have Mary patched in on a conference call or webinar, we can set that up for you as well. But most important, we want to make sure that you walk away with these strategies that you can start using in your everyday practice. And I'm just going to give you a quick 100-foot overview because she has a lot to talk about today in a short time. So I don't want to eat away at her time today. But I just want to mention, if you're an agent out there, and I know we have agents for a fact from Key West literally to Hawaii, in almost every city in the U.S., right? And some of you are, let's say, more focused on final expense and term life insurance. That's fine. And some of you, I know, are estate planning attorneys and CPAs that are also life licensed and CLU, CHFC designations, okay? Even our living benefits course, maybe you took that and you're certified. Wonderful. Point is, we all know someone. We have a guy, we have a girl, okay? And they might be perfect for some of these strategies. And you might not, maybe you're a little greener, okay? Maybe you're not up to speed with some of the latest things going on in the tax environment in 25 and even 24 for last year. So that's okay. That's what Mary's for. She will do as little or as much that you need her to do. She'll do the heavy lifting for you, or she'll talk to you for a few minutes, make sure you're prepared, and then boom, you go and make the sale, or she'll do the heavy lifting, like I said. And best part, we worked out a special arrangement with Mary over the years where you keep a bulk of the compensation, even if you're using her for the heavy lifting, okay? So that's okay, especially think about some of these large businesses, business owners, okay? And you need a foot in the door and you're using one of these strategies. She will help you every step of the way, like I said. So this is such a great opportunity. Her average case size, it used to be like 80 to 100,000 of commissionable premium. I'm sure it's higher now. Okay, but these are monsters. This will change your year, change your life in some cases. So please make sure you're paying attention. This is going to be awesome. And a big kudos and thank you to Mary for joining us. And most important, she's going to be one of our two keynotes at the Levinson Expo, April 11th. You'll get to hear her live, okay? And by the way, she's also authored 3 awesome books that I have here in the cabinet next to me, and an ebook. That's her latest version. So we're going to have those at the expo as well. Anyway, it's just great stuff, all the above. Let's jump right in. Make sure you're on until the end, too. We have our webinar prize giveaway. We're giving away the new Apple iWatch. So we're going to ask a question that has to do with our slides. Whoever answers first and correct, we'll announce your name at the end. And yes, you walk away with Mary's prospecting book, Distribution Solutions, and the Apple iWatch. All right, let's jump into the first slide. By the way, I only have 3 slides here, and then Mary's taking the wheel. I'm not going to rant forever like I usually do. I promised I would keep this short real fast. These are from our agents, and they just came in. They're fresh, hot off the press. I love to see this, okay? At the end of the day, we are not a retailer. We are 100% wholesaler, distributors. I call it an IMO, BGA, whatever you want. The point is we don't fish in the bucket that you're fishing in going after clients. Our job is to make sure you, our agents, are happy, period. Okay. And by the way, it's a conflict of interest if agencies are also working in retail and wholesaling. In my opinion, it should be illegal, but I'm not getting into that right now. Tedra, real fast, you all are doing a great job, very thorough. Right-hand side, RJ has been very helpful in understanding my needs as I return to the business after many years' absence. On the bottom, I want to thank you for your attention and help as I onboard and contract with multiple carriers. You've made a scary process smooth and easy. Roland, that's our goal, okay? I love to see this. It moves the needle internally for everyone here, our staff, our team, our family, okay? Which, by the way, we're in 3 different states now, different time zones here to make sure our agents are taken care of 110% of the time. Let's keep moving. So the big expo, this is our big powwow for the year. We're capped at 300 agents because of fire code. So we're in the largest room the Hilton has. Okay, it's the Hilton in Deerfield Beach, right on the ocean, on the sand. What's so cool about this, number one, you literally look outside. We're going to have a lunch, a network lunch on the ocean, okay, which I know a lot of you from up north. This is going to be a sight to see. But most important, everyone says, Bill, how do I get motivated? What's the best way to get inspired? How do I make 25 the best year to date? Okay, and the answer is actually very simple. It's surround yourself with others that are at your level or higher or better or more successful. And what a perfect place to accomplish that, okay, within itself is the April 11th Expo, okay? Icing on the cake. Look at the 2 keynote speakers. We have Mary Reid. She's going to have 1 full hour. In fact, we're going to break it down into 2 30-minute sessions for her, okay? And then one of my favorite annuity sales coach, Mr. Charles Samuel, is going to be joining us as well for an annuity keynote. We've never done this before, folks. So I'm excited, and I hope you're excited, because between Mary, her keynote, and then Charles, what he's bringing to the table, these are big cases, okay? We're not talking about, final expense, MLM, they call them brogencies. No, this is top of the table stuff here, okay? That, again, will change your year for the better. And by the way, there's nothing wrong with final expense and term sales, okay? You have to attack the low-hanging fruit, use them as door openers, and then ask the right questions. We know how that goes. Bottom right-hand corner, starting at $30,000, qualify for a 2-bedroom beachfront suite at the Hilton Hotel, and then $60,000, $70,000, we're paying round-trip airfare. Here's the problem, though. You only have a few more days. In fact, 2 more days to get in those apps. All applications count. So if you're close, let us know. We'll work with you and get you over the hurdle there. Let's go to the next slide. This is my final slide, and then we'll introduce Mary Reid. Real fast, these are 2 incentives. We all love cash bonus, cash incentives, Amazon gift cards. Left-hand side, these are the supplemental products, okay? Great for door openers, critical illness. We have disability, accidental death, medical. Everything is here with Manhattan, and it's on our direct-to-consumer Insure Me Now Direct platform. Hopefully you're using. You get $75 to $100 cash with each app. Right-hand side, okay? Love this. We rolled it out on Valentine's Day. Best part is you can earn up to $1,250 cash. That's above and beyond the excellent compensation direct from the carriers, okay? FIAs, one-stop shop here at Levinson. Let's go to our final slide. I want to introduce Mary Reid. Again, Mary, thank you so much for taking the time today. And then obviously in about 5 to 6 weeks at our expo, we're all super excited to listen and learn from you. So Mary, the stage is yours.
All right. Thank you, Bill. Thank you very much for that introduction. And I'm definitely looking forward to seeing everybody in nice, warm Florida, as opposed to where I am in April. Be looking forward to that. So let's get into the topic. So Bill talked about, before we actually get into the subject, these are large premium cases. I work in the qualified plan space, so everything I do has to do with money, either going into qualified plans or coming out of qualified plans. So the wonderful thing also about using that money is the numbers can be quite large. which means the premiums can also be quite large. But better than that, when we're putting money into a qualified plan, the IRS is picking up part of the premium cost, right? Because everything we put into a qualified plan is tax deductible. So if I have, I don't know, let's say if I put $100,000 into a plan and I'm in a 40% tax bracket, I just saved $40,000. So let's let the IRS pay for our life insurance with those tax savings. So it can take kind of the sting out of paying those premiums for some business owners. All right, so when I talk about qualified plans, I'm talking about 401k plans, defined benefit plans, profit sharing plans, cash balance plans. Those are all qualified plans. SEPs and Simples would be too, although they're the IRA versions. Qualified plans fall into two basic categories: defined contribution and defined benefit. Defined contribution plans define how much you can put in. Like a 401k plan, you know what your salary deferral limit is, which, by the way, this year is $23,500. And then the employer can make a contribution, but the most you could get this year would be $70,000, unless you're 50 or older and you add the catch-up. Defined benefit plans work just the opposite. There is a limit on the benefit, however, under the IRS rules, but the contribution can be whatever is needed to get there. So we go to defined benefit plans when we want bigger contributions because we don't have that $70,000 ceiling here. So that's what we're going to talk about today. We're going to talk about the opportunities with these defined benefit plans. And this is a great time to have this conversation with business owners and with CPAs, because what are they starting to do? They're starting to work on their taxes for 2024. We can still put these plans in for the 2024 tax year up until that client files their tax return. Our end date would be September 15th of 2025 to put in a plan for 2024. So this is a great time to have these conversations. So when you're talking to that business owner, it's really pretty simple. Do you want to pay more taxes or less taxes? I have yet to find the business owner who wants to pay more. And so if they're sitting with their CPA, or you're having the conversation with them and you say, you know, has your CPA gotten you every deduction they can? Whether their answer is yes or no, the second question is, have you looked at a qualified plan? If the answer is no, then they have not looked at every deduction they could have. And that CPA hasn't finished the job. So there's your opportunity. You know, we're not getting really fancy here. It's just about tax deduction. Have you looked at this or not? In addition to that, some other benefits of putting money in a qualified plan is all money that goes into a qualified plan, if you have one rank and file employee in there with you, is fully protected from creditors. Nobody can ever come and take that money away. There are only two exceptions to that rule. One is the IRS. They write the rules. They go wherever they want, and your spouse. But nobody else can ever get at that money. And in some businesses, that can be an important feature. Do you want to let the IRS help you save money for retirement or get in the way? Right? The IRS makes these plans deductible to incentivize business owners to put them in. We also now, by the way, have tax credits that business owners will get in the first 3 years of the plan for putting the plan in. The IRS wants you to do these plans. And as a business owner, this is one of the advantages you have, among other, but only business owners can set up these plans. You know, if I work for some company and I'm a W-2 employee and I have a tax problem, I can't fix it with this, but this is an advantage that business owners have. So I talked about the two types. It said defined contribution plans. Now, I have nothing against defined contribution plans. If you find 401k plans out there, great. There's a lot of legwork on those, a lot of work on those. If it's a takeover, you can make some nice money because there can be some money in there. So don't hesitate to get into those. But my focus today, as I said, is on the defined benefit plans. So when you're talking to that business owner, right, would you like to save on taxes? Yes. All right, so give me an idea of what it is you want. What would you want this plan to do for you? How much money might you be able to put in, be looking to put in? Are there employees you want to favor? Are there employees you don't want to favor? Considerations, as we're going to take that information and then go design a plan to get as close to that business owner's objectives as possible. Factors that will come into play will be employees, right? We can't ignore the employees. They won't necessarily all be in, but some will be in. How much income everybody makes, how old everybody is, and then later on we'll also talk exit planning from that plan, not day one, but that will come down the line as well. But the idea here is we're going to custom design every plan for each employer. We're not taking a plain vanilla plan and slapping it in here. This is going to be a plan designed for them. We'll get as close to their objectives as we can within the rules of the law. All right, so let's take a look at an example. Here's a pretty typical little company here. I've got Pat and Chris own this company. Maximum compensation last year was $345,000. This year we're up to $350,000 that we can recognize. Their child is in the business, and then we have these two employees. We have one employee who's age 27 and one who's age 62. Now, this can make us a challenge. We have two things to leverage off of when we do plan design: age and pay. The older someone is, the fewer years they have to get to retirement, the higher it will drive the contributions. Higher pay also drives higher contributions. So this 62-year-old could look like a challenge. Now, it'd be very common for this company to have a SEP in place. Very, very common, because they sat down with their CPA when they were doing their taxes, and they said, what other deduction can you give me? And the CPA said, well, you could do a SEP. Right? SEP is free. It's easy. You just fill out this IRS form, and then you open up IRAs and you put the money in. So here, this is 24 numbers, right? If we were doing this plan for 24, we could give Pat $69,000 and Chris $69,000. Everybody has to get the same percentage of pay. My one employee gets $9,281, and employee two gets $6,188. All that money goes into IRAs. So if those employees leave tomorrow, they take that money with them. But what if we could make this plan better? What if we said, Pat and Chris, you can still get $69,000, but rather than giving about $15,000 to your two employees, what if we changed that to $3,750? Would you like that better? Most employers would say yes. Well, to do that, we have to go to a profit sharing plan instead of a SEP. That's all. Just have to switch it to a profit sharing plan, and now we can get some control over who gets that money. So rather than giving $15,000 to the employees, we're giving $3,750, and our owners are still getting the same amount. It is a more efficient design using tools that are not available in the SEP. Now, what does this plan really cost? In this plan, we have a total contribution of $145,500. In a 34% tax bracket, that's a tax savings of $49,470. So to actually make this plan contribution, it really only costs this business owner $96,030. Our three family members are getting $141,750 of the $145,500. So if they're getting $141,750, but it's only costing them $96,030, they just came out ahead $45,720. If they don't like the plan and they don't want to do it, because heaven forbid we don't want to give that $3,750 to those two employees, saying no costs $49,470. You don't get to keep that money. You're paying that in taxes. Why wouldn't you say yes? If I could take you from a $49,470 loss as expense to a $45,720 gain that's going to build wealth for you for retirement, why would you not want to do that? Now, this is a profit sharing plan. We take this into the defined benefit world, we get the same results, but with much bigger numbers. So another aspect here that the CPAs will be aware of, right? The Tax Cuts and Jobs Act had brought in this 20% 199A deduction. This was to compensate pass-through entities for the lowering of the 15% tax rate for C corporations, right? Nobody else got that. So what they wrote in was that if your income is below certain thresholds, you can get this added 20% deduction. However, if you're a pass-through entity in a service business and your income is above those thresholds, you lose that 20% deduction. So now here, let's take, this is a company that came to me. This is a husband and wife, just the two of them, no employees. with $700,000 of taxable income. They're a sole proprietorship. They had a $250,000 tax bill. They wanted to get that tax bill down. We put in a defined benefit plan for them. This one happens to be a 412(e)(3, fully insured. This is annuity only in this plan with a $405,000 contribution. So where's the $405,000 going? It's going to them, just rather than taking it as pay, they're putting it in this 412 plan for themselves. So that makes it deductible. That brings their taxable income down to $295,000. That brought them below the threshold to regain back their 20% deduction. By the time we were done, we got their tax bill down from $250,000 to $50,000. So if you're talking to this business owner and they're complaining about their tax bill, and you ask them, have they done everything they can? Have they gotten every tax deduction they can get? And they say yes, and you say, have you looked at a defined benefit plan? If the answer is no, then maybe they haven't. You know, maybe they're sitting there with that SEP and putting in, you know, just under $138,000. What if we made that 405? That could bring a whole new set of tax savings here. We're saving them almost to just about $200,000 in taxes. So defined benefit plans, we want to go to defined benefit plans because they have very large deductible contributions. In terms of building money for retirement, right now we can build a lump sum for retirement of about $3.4 million for someone. They have that creditor protection. They can work also as a tool to transition an older generation out of the business. Let's say the kids are buying the business from the parent. This is a way to fund money to the parents, because this plan will favor whoever's older, to help them move out of the business without immediate taxation. The challenges, right, nothing is ever 100% good. The challenges here, this will be a commitment. Once we design this plan and the company adopts it, they're committing to making an ongoing contribution. Now, it's not pension prison. We can always amend the plan or change it later on, but essentially they are committing to an ongoing contribution, right? In a 401k plan, anytime you can change your contribution. You don't have that same degree of flexibility here. Company demographics will drive the numbers depending on the ages and the pay of those employees. We want to watch investment performance here. In a 401k plan, the participant benefits from gains or losses on the investment. Their account goes up or down accordingly. Here, it's the employer who takes on that risk. So we always have to keep this benefit that's defined in the plan document funded. So we don't want to take a lot of investment risk here. Annuities can be a very good fit for funding these plans. And we also don't want to end up overfunded. We don't want to end up underfunded or overfunded here. We want to stay on a nice level, easy, predictable track. Life insurance can help there, and annuities can help as well. But you can have other investments if you want to. So how big a deduction are we talking? Here's my same little company, right? Giving Pat and Chris their $69,000. Look what happens if we go over to this defined benefit plan. Now the contribution for Pat is $385,000, and for Chris it's $398,000. We're not talking about an incremental little jump here. We're talking about significantly greater numbers. Now, these are the maximums. We can go in between if the maximums are too high for them. So in this profit sharing plan, we had $145,500 contribution. The family got $141,750 of it, and their tax savings was $49,470. If we go to the defined benefit plan, we have a contribution of $895,051, of which $810,000 goes to the family, and additional tax savings of $304,317. We have now given this tiny little company of 5 people tax savings of $353,787. Now, is every little 5-person company that rich? Certainly not, but many of them are. You will find them out there if you go looking for them. And again, have you done everything you can to get every tax deduction you can get? If they haven't done this defined benefit plan, they're missing out on $304,000 of tax savings. So I would say that was that answer was no if they haven't looked at this. All right, so here are the limits. Right now we can fund it's defined as a life annuity. These are the IRS requirements of $280,000 a year as a life annuity. As I said, right now that translates into about a $3.4 million lump sum that we can fund to for someone to walk away in 10 years. It's a nice chunk of money. They're giving the money to themselves here. We're not giving it away. We're giving it to them. Yes, if there are employees, the employees will get a little bit, but hopefully they'll be covered by the tax savings. As I already said, what will the contribution be? It depends on age, and it depends on how much they're paid, and also on years of service. So this is why you need a proposal. We will run the designs so we can see exactly what that contribution comes out to for everybody. We only need some basic information to do that. We need everybody's dates of hire, dates of birth, and salaries. And then just a little bit of information, what's the form of business of the company, S Corp, LLC, whatever they might be. It's not a lot of personal information. Now, the business owner is likely to have some concerns. As I said, this is a commitment. So what happens if my business goes south? Well, we don't want to put these plans in for companies that are volatile. So if they know they're already volatile, this may not be a good fit for them. But let's say they've been steady or they're on the climb. If something unforeseen happens in the future, as I said, we can always amend the plan and reduce the formula to cut back on the funding. If worse happens, we can terminate the plan. So it's never pension prison, it's opportunity. And if the business owner changes, the business situation changes, we change along with it. Another reason with this business, it's good continuing business with your clients because you need to see them every year to talk to them about this plan. You need to have an annual review to check in with them. How are things? How's your business? Has it grown? Has it shrunk? How are you doing? It gives you a reason to be in front of that person every year. Now, life insurance. You can include life insurance in these plans, in all of these qualified plans except SIPs and Simples. So does it make sense? Well, we know it's going to pay sometime. Business owners are not immune from the statistics. And of course, the advantage here, we get to pay the premium with those tax deductible dollars. So if you're in a 30% tax bracket, let's say, let the IRS pay a third of the expense of the premium because they're going to give you that tax savings back. And of course, for those who do make it to age 65, we know what will happen someday. So this will be a benefit, right? When you buy a life insurance policy, you're creating an asset. Now that asset will pay upon the death of the insured, but you have created that asset. So let's talk about fully insured plans. Now, defined benefit plans come basically in three types. What's known as traditional defined benefit plan, that has the limits we just looked at where we can fund to that 3.4 million. That plan can be invested in anything that the plan trustee wants. The plan trustee will be the business owner, anything they want. Then we have 412(e)(3) plans, and the only difference here, same limits, same rules, except the plan can only be funded with annuity contracts that meet the requirements. They have to be level premium annuity contracts. And you can have life insurance in the plan. You don't have to, but you can. If you do, it must be whole life, and the two products must be from the same company. These are IRS rules, not the insurance company rules. There are only about 4 companies that are active in this market, National Life being one of them, and National Life currently being probably the longest standing company that's been in this market. They've been doing it for 100 years. So they have a strong presence here. They have all the backup systems. They know what they're doing. We administer a lot of 412 plans for National Life. National Life has always written a lot of them. So this is an opportunity for you to bring this out to employers. Now, why does the employer like it? The employer likes it because everything is guaranteed. There is no market risk here. Everything is guaranteed. No risk of being in the market. So it makes the contributions very steady, very predictable. They can plan for that. Also, when we're doing the calculation of what the contribution will be for a traditional defined benefit plan, because that plan can be invested in anything, we have to use market rate based on treasury rates. Right now we're using about 5%. When we do those calculations for a 412 plan, we have to use the guarantees of the underlying contracts. Those will tend to be lower than market rate. If we're using a lower interest growth assumption, what does it do to the contribution? It drives it up. we have to make a bigger contribution because we're not expected to earn as much. So for that business owner who really wants to maximize their deductible contributions, the 412 plan may be the plan that gets them there. So who's a candidate here? These are for small companies, typically less than 5 employees. They can be a little bit larger times, but these are typically small companies because we can't manipulate the money here. We want them to have high, stable cash, profits. They want to have the cash flow to be able to make the contributions. We want an older owner and younger employees. They want this big tax deduction. They can pay those contributions, and the minimum commitment here is 3 years. Ideally, we want a 3 to a 5 year commitment, longer if they can do it, but absolute bare minimum of 3 years. So here's my same little company. Right now, what happens if we went to this defined benefit plan? If we went to this 412E3 plan, if we did annuity only, the plan contribution becomes $742,292. Here's the lump sum each person will receive if they're here all the way till retirement. Now, you notice it's not 3.4 million because our owner's 61 when he's going to retire, and we have a 5-year horizon here, so it gets cut in half, approximately. If he was younger and we had 10 years, we could go up to that 3.4 million. But here, so we have $742,000 of deductible contribution. If we add life insurance to this plan, remember it's whole life. You can see the death benefits we're buying for each person here, and in these plans, everybody gets a policy. Here's our contribution. If we add the life insurance, the contribution for this plan goes from $742,000 to $895,000. How big a deduction do they want? Do they want to really max out? $895,000. Maybe they want life insurance. Sometimes they maybe they don't want $14 million of life insurance in this plan. We can always cut it back. Sometimes they just want enough to make the plan self-completing in case they don't make it to retirement and that money's going to be needed there for their surviving family. All kinds of reasons, but just strictly financially, we get tremendous leveraging to pay the premium. So let's look at that leveraging. The annuity, right, contribution to this plan was, remember, the retirement benefit is exactly the same, whether we have life insurance or not. It's just that if we have life insurance, some of it's funded in the life policy and some in the annuity. If it's only annuity, it's all in the annuity. So here's our difference in contribution, right? Between the annuity and when we added the life insurance, the contribution went up $152,759. Now that is deductible plan contribution. So with I'm assuming a 35% tax rate here, I take off the tax savings. To buy this insurance really costs $99,293. Look at the premium. The premium for these policies is $444,062. Where else can you pay a $444,000 premium for $99,000? And if you could buy the insurance that $444,000 premium would buy you, and I could buy it for less than a quarter of the price, maybe I'd be more inclined to buy it. Why wouldn't I buy it? I'm getting a huge leveraging advantage here. Now, these are very big numbers. If we're not going all the way to the max, you might see that adding the insurance only costs $20,000 or $1,000. All it depends what the numbers are for that case. Sometimes it's so low, it's almost a no-brainer. Of course, we're going to add the insurance because the cost is so minimal. But here, even with these big numbers, now I'm sure everybody on this phone call has just calculated what their commission is on a $444,000 whole life premium. I don't have to do that. So also another reason, as I said, this kind of plan design makes the contribution very steady. If we did this plan as a traditional defined benefit plan, funding for this 52-year-old, I looked at the actual S&P returns. This gray line is what their contribution would be each year. You see it bounces way around if they were just in the market in a general portfolio. Look at the blue line. That's the 412 plan. It stays nice and steady. They can plan on that. They can predict that so they don't get surprises along the way either. This is a nice, comfortable plan to adopt. So we bought this life insurance with pre-tax dollars. A lot of CPAs will think that means that the death benefit is going to be taxable. If we paid it, if we got tax advantage on one end, we don't get it on both ends. Not true. When we buy life insurance in a qualified plan, the premium is 100% deductible. The death benefit, the pure amount at risk, is always income tax free. So if I had a life policy, and let's say at death, we had $1 million policy, and that policy had $100,000 of cash value in it. The beneficiary is going to get the $1 million. The pure amount at risk, $900,000, will be income tax free. The $100,000 cash that built up in the policy was counted as funding the retirement benefits, so that's considered retirement cash. That will be taxable. That could be rolled to an IRA if the surviving person is the spouse, the beneficiary. But that doesn't mean we made the life insurance taxable. That $100,000 was going to be taxable no matter what financial vehicle it was in. What we did was we gave them an additional $900,000 tax-free benefit. Now, 412 plans are nice, great, stable plans, but companies are not always so cooperative. What happens when we have older employees who are sometimes higher paid, or we have partners who are different ages and they want equal benefits? We can't do that in a 412. We have one formula that covers everybody. Everybody's individual age and pay will drive their particular numbers, but we have one formula that controls everybody. So if I have a mix of employees, or I want to gain control because I want to change the amount that's going to somebody, I want to go to a cash balance plan. Now, a cash balance plan is a defined benefit plan, just like the traditional, and the 412, which means we have the same limits, can fund to the same 3.4 million. The difference is in how we're going to define it to get there. And here we're going to get a lot more control. And the reason is, in these plans, in a traditional or 412 plan, the defined benefit that we're funding to is typically defined as a formula that pays at retirement. For example, you'll get a benefit of 100% of pay when you reach age 62. A cash balance defines that benefit as a current annual contribution credit. Let's say that credit was $100,000. Well, if that person left in 10 years, they'll get $100,000 10 times. They'll walk away with $1 million. Plus, they would get an interest credit each year. That is defined by the plan document. It's got nothing to do with the actual results of the investments. So that benefit is defined. It's just stated differently. But by doing that, we can put employees in different classes and give them all different amounts. We do still have to pass our testing. We can't just be indiscriminate about it, but we get to put our employees in different formulas. So we can give a different percentage to different employees to give them what we want to give them, not what they automatically default into. Behind the scenes, the money is all invested in one pooled account. There are no actual individual accounts. They are on paper only. But that is how the benefit is defined. And of course, because they aren't actual accounts like we would have in a 401k plan, we're not limited to that $70,000 this year. So let's look at how this can work. This is a real client. We have an owner who's 55, earning $200,000. Their spouse is on the payroll as well for $45,000. And then we have these two employees. Now this employee is nice and young, but we have a 50-year-old employee, not making as much as the owner, but they're making more than the spouse. This company, the owner wanted to favor themselves. They didn't want to give the money to the employees, but they wanted the deduction. So we designed this plan in their favor. This is two plans working together. This is common, and when we design a cash balance plan, we do it paired with a 401k plan. We test them together. That gives us even better leveraging. The two together will total what everybody gets. So here, we give our owner, on $200,000 of earnings, a cash balance annual contribution credit of $204,748. That is 102.4% of pay. For the spouse, we're able to give on $45,000 of pay $166,696, which is 370.4% of pay. Remember, this is every year. We give each of our employees 2.5% of pay. That is clearly a discriminatory formula any way you look at it. So now we have to go over to our 401k plan and see what do we have to actually give these employees to get past our testing. We have salary deferrals in here. I just have the owner deferring, but the employees could defer too. I just have them as zeros because I don't know what they might do. I've made this a safe harbor 401k plan, which means everybody's getting 3% here. Then I go to my profit sharing, which is flexible, and I say, what do I have to give my employees to get past my non-discrimination testing? Turns out I have to give them another 4%. I could give my owners another 2%. So when I'm all done, my employer contribution here, plus I have the salary deferrals, but my employer contribution gives 120% to my owner, 375% to my spouse, and 9.5% to my 2 employees. This plan gives 97.6 of this 418,000, that's with everything, the employer contribution, 392,000, 97.6 of that is going to our 2 owners, and only 2.4% is going to the employees. So when you're sitting with that business owner and they want deductions, and you say, have you looked at a qualified plan? And they say, I did, but I'm not going to do that because I'm not giving that money to my employees. Wrong answer. What are we giving to the employees here? We're giving them about $8,500 out of $392,000. Who's paying that $8,500? The IRS is, because our tax savings here far exceeds what we have to give to the employees. Whereas if they don't do the plan, they're paying taxes on this $392,000. Sometimes it's more about flexibility. This was just a husband and wife, a nice little plan. They wanted some contribution flexibility. So we did a cash balance for them because we give them more contribution flexibility as well. We only had insurance on the owner here because the other owner was uninsurable. That's okay. But with this nice little design, we gave them a minimum contribution of $166,000 and a maximum of $303,000. They like that because they were having a good year currently, but they're not so sure that next year is going to be as rich. And so they have this ability built in to flex it. We would not have this flexibility in a 412. Now, if they don't need the flexibility, the 412 is fine. But if that rigidity of the 412 makes them uncomfortable, we'll look at a cash balance. And of course, these plans can include insurance, just like the 412 plans. They can include the annuity, just like the 412 plan. So who's your ideal candidate here? We're looking for business owners who are profitable, have cash flow to work with. Maybe they want to save for retirement. Sometimes that's a driver as well. Sometimes that creditor protection is a driver. Sometimes it's about passing wealth between generations, and this is a tool to help us to do that. And you can find these either directly by talking to business owners themselves or through CPAs. We want to ask the employer, how much do you want to contribute? How much do you want to work with here? Again, are there particular employees you want to favor? Are there particular employees you don't want to favor? You fill out the fact find, it gets sent over to me, we design the plan, and then we see what we can do for this business owner to get them on track to what they want to do. And it's a pretty simple process. As Bill said, I can do quite a bit of the heavy lifting. And remember, this is a great opportunity because we can do this up until September 15th for these businesses, so long as they don't file their tax return. We do need 60 days notice ahead of time. So just keep that in mind. We need some time to get it done. So I know I've run full time, Bill, but I'll be happy to answer any questions if you want to bring them up.
Okay, thank you, Mary. First of all, that was great. And I know a lot of information, but well worth it. I always learn something. We got a bunch of comments and questions. JC, can you hear me okay, or are you getting a little background noise? Is it clear?
I hear you fine, yes. Yes, sir.
Okay, perfect. Okay, so, yep, I have a question, Mary, that came in from Al. Can a one-owner employee of a regular C Corp have an executive bonus plan under Section 162 and also own a 412E3 plan?
Yes, they can do both.
Okay, perfect. Al, I think that answers your question. Pretty cut and dry. Let me just see what else
that was as short as
I have.
Yes. Uh-oh, did we lose Bill?
Bill, just in case we cannot hear you right now. Can you hear me, Mary?
I can hear you. I think we lost Bill. Did we lose
I'm
Bill?
going to go.
You can hear me, right?
Yes, I can hear you. I'm going to go check on him.
Okay.
Okay, can you hear me now? Okay. I think my phone.
I can hear you fine.
Sorry about that. Okay, so thank you, Mary. So I apologize. The headset cut out. But my point is just that you have now enough key bullets to go out and create your marketing pieces, your drip mails. I would follow up with phone calls, and we have a section on our website that's dedicated to Mary, her books, her strategies, business owner concepts, sales ideas. So a bunch of stuff that you can resource, leverage. We're going to send out a thank you email tonight, and we'll include the links for all of this, so it'll be at your fingertips. Okay, let me do this. If you have a guy or a girl, you have someone interested, you're an active Levinson agent, just send me a direct email, and then we can get Mary on a call, and we'll go from there. Okay, so just know that. All right, JC, if we can jump into the first slide here. And then, by the way, as you know, April 11th, you'll get to meet her face to face if you're at the expo. So I can't encourage you all enough to be there and make sure you're registered, because we're going to be filled up probably in the next week or two. Okay, we'll go to the first slide. Thank you again, Mary, by the way. So how to get started real fast. If we can go to the first slide, that would be great. There we go. Okay, so I know most of you, and I see all the names here. By the way, we have a record number of agents on today, so thank you all for the participation. I love to see this. To get started, if you're already with Levinson, you have one carrier, two carriers, 10, whatever it is, great. Mary loves to work with these two carriers that you're looking at on the left-hand side, Lafayette and LSW, National Life Group. In fact, she used to run National Life Group many years ago. So another another kudos for her. But anyway, those are the two carriers. So make sure you're set up for the special arrangement that we discussed earlier. You're set up with Levinson and the carriers, and then we make the introduction to Mary, and then you and her will take it from there and hopefully land the case. On the right-hand side, that is part of the platform I spoke about earlier, where we have a bunch of marketing resources for you to use to start to drip on your clients, network, friends, family, because you never know what it could lead to. And it just takes one person, one case, one business owner, and it'll change your year, your life. Okay, you heard we were talking about $400,000-$500,000 of commissions. I mean, this isn't just fluff, and we're trying to blow smoke. These are cases that we've seen. We had a $1.2 million target case about 4 years ago, okay, from an 82-year-old man, okay, from one of these strategies. So it works, okay. And in fact, I'll probably be at our expo. So if you want to meet the guy, let me know. But this stuff works. Anyway, let's keep moving forward. So this is the landing page I was talking about a few times. So we have dedicated resources just for this part of the industry, and it allows you, even a third bedroom agent in Cedar Rapids, Iowa, right, to tap in, put together a marketing campaign, start to get the emails out, the phone calls, start to put out some social media posts on these concepts. Everything's already made for you. Okay, and we have the carrier approved pieces as well. So you don't have to worry about, what if I have a logo here, a carrier logo? I don't want to get in trouble from compliance. Everything's pre-approved. Okay, so you're all set. We can even help you co-brand with your name, number, phone number, or I'm sorry, name, number, email. Okay, even a picture of you if that's what you want to do, or your company logo, all the above. Okay, we're here to help, and there's no charge, by the way, for any of this. Let's keep moving forward. Okay, just a few more minutes left, and then we'll put a bow on this. Joe Ross, another excellent speaker. Okay, he loves the IUL concept and strategies. He has the butterfly chart, which is amazing. His napkin presentation, all of this is on our website. What's so cool too is I did a podcast with Mary Reed. I did another podcast with Joe Ross. So all of this is sitting on a free platform, okay? But you have to dive in and listen and learn, okay? It's up to you. Everything's laid out for you. It's complimentary. You have to jump in. Next time you're on the treadmill, you're doing your yoga or walk around the block at night, okay? Throw your headphones in, listen, learn, move the needle. Period. Okay? Let's keep moving forward. I know I talk about this all the time, but I just want everyone to learn and try. If you've never had a case like this, you've never marketed bullets like this, okay? Try. If you get stuck, you have a dead end, there's a question you can't answer, we're here to help. And then Mary is here to help all of us, okay? So just know where to go for answers is the key. I always say that even to our employees. Okay, moving forward, I spoke about some of our Levinson courses. We have online courses where you get a certificate, okay, when you graduate or pass the class. This is one of them. It's awesome. And these are proprietary to Levinson and the carriers. The Living Benefits Certification course, okay? Once you're set up with LSW and Levinson, yes, you'll have access to Mary, like I said a few times, and the LB course, which is the new kind of life insurance that pays while you're still alive. We all know how that goes. It's a great marketing pitch to open doors for clients and prospects. Let's keep moving forward. So next up, I promise you every single week we have our social media posts, okay? And here's the reasoning behind this. I know I speak about this a lot. Very simple. You don't have to reinvent the wheel, okay? When you look at these 4 posts in front of you, you're talking about 500-600 people saw this and liked it, okay? Over 40 comments between all of these posts. And how did we find these? And I want you to do the same thing. Write this down. Go to Instagram, go to Facebook, go to LinkedIn, okay? You can put in Indexed Universal Life, Whole Life Strategies. You can put in 412 plans, defined benefit plan, okay, anything. And then it'll ask you for recent or top performing. And I always click top performing. I want to see what's working for others, right? If I'm an agent out there, oh, this is working great. Look at all these likes and comments. And then I'm going to do something very similar. I'll change a few things, but for the most part, it's the same post. Okay, you can do this. And I hope I'm encouraging you to give it a shot. Okay, now, here's what I want to add real fast. Okay, and I think this is important. We have a section dedicated just for social media posting. We even have a third-party company that will do all the posting and social media management for you. And no, it's not thousands of dollars. We're talking like $89 a month. Okay, and there's no contract for 10 years, nothing crazy. But you got to get the word out, okay? And I think I've said it enough. Let's keep moving forward. Almost done here. Real fast, the 411 newsletter. And this is important because all strategies, as far as marketing life, annuity, carriers, products, what does Levinson have to offer? What lead programs can I leverage that I get a discount on, okay? Everything is in the 411 Life and Annuity newsletter. It's sitting in your inbox every other week. And it's fresh, real time, updated. So, in fact, we just sent out the last one a couple of days ago. If you didn't get it, it's probably in your spam folder, or we may have your wrong email address. So if that's the case, just call in, let us know the correct email. Let's keep moving forward. Almost done here. The Bill Levinson Experience podcast. This is a great tool. If I'm an agent out there, I don't care if I'm 87, right, in the middle of Austin, Texas, or 19, just out of high school, okay, going into college, and I'm life insurance licensed. I need to learn, right? You never know everything in this business, no matter how long you've been doing it, right? So this is a free tool where you can put on your agent hat, your interviewer hat, and sit down with these successful agents for an hour and pick their brain. That's exactly what I do, okay, to help you all. So on the left-hand side, that was Mary Reed, number 21. On the right-hand side is episode 56. I just launched this week, but this is a 30-year-old guy. In fact, he's working on a $700,000 target premium case now with Allianz, an IUL case. Okay, it's one of Mary's strategies that worked. So you got to leverage the resources that are available at no charge, and I think you'll enjoy this. And if you walk away with one idea, then it was a win and it cost you nothing. Okay, so check it out when you can. We'll include all of this in our thank you email. Okay, my second to last slide is our agent training guide. This is everything that's coming up, everything that's around the corner, everything you need to pay attention to keep learning, right, and moving the needle. How to do business with Levinson in 25. This is everything from A to Z. Some agents come in, they're newer, they say, Bill, this is overwhelming. Okay, we simplified this, everything on this webinar in 45 minutes. So on the 6th of March, just under that, oh, that's funny, exactly what I was just talking about with our social media packages and a professional WordPress retail website that you can set up. I think the whole package is like $130 a month, okay? And there's no startup fee or anything like that. It's very, very inexpensive. But if you don't have a website, if you don't have someone managing your social media, I would definitely encourage you to do this. Just under that, we have CoreBridge. That's going to be a big one on the life and annuity side. First time we ever did that. We're going to split it up right down the middle, 30 minutes life, 30-minute annuities on the 20th. Just under that, another first ever, Lloyd's of London. Okay, talk about niche products, right, that no one else has. Your clients can't get from anyone else unless they're a Lloyd's agent. Okay, so that's a great, great webinar, and you'll walk away with some new sales ideas from that one as well. On the bottom, speaking of Allianz, that's our relaunch IUL webinar going over rate locks, some other neat features on the 3rd of April, right before the expo. So make sure you write these down or just watch for our newsletter, and everything is in there too. Our final slide here, my question of the day. I know everybody's waiting for this. They want to walk away with an Apple iWatch and Mary's Distribution Solutions prospecting book. Before I ask the question, I'll give you a minute to take a deep breath and get your little fingers on your keyboard. What I want to talk about is our Positive Tuesday quote. I do this every single week, and I'm not doing it to go out and create new sales and new prospects, because we don't do that. We wholesale. I want you to learn from this. Why? So you can come up with your own cute little quote, or call it the Long-Term Care Thursday, IUL Monday. Okay, talk about some of the product bullets or riders, whatever. Come up with something cute every week just to get the word out so people remember you are the guru. You're the go-to when it comes to insurance and annuity products. That is the whole idea. Okay, don't listen to what I say. Watch what we do. Some people's opinions of you really do matter, especially the ones who are already achieving the goals you're striving for. Okay? Just think about those top MDRT agents. If they say, hey, try it this way, you listen, right? And then learn, and hopefully it works for you too. Surround yourself with greatness. My question of the day, I spoke about Mary's plan for the last hour, and so did she. And the question is, what are the 2 carriers that she recommends you using with her strategies? What are the 2 carriers that you need to be appointed with under Levinson to get access to Mary and her awesome platform and sales ideas? You tell me the 2 companies, you walk away a winner. JC is going to tell us who was first and who was correct.
Greg O.
JC, do we have a winner today?
Yes, sir. Greg O.
What was it, Greg O?
Yes.
Greg O. Congratulations. The 2 companies were Lafayette Life and LSW, National Life Group. Congrats, Greg. Congrats to all of you for sitting here for the last hour with us. I know we had a couple little issues, but for the most part, I think it went great. I learned something. I hope you did as well. Great selling, and thank you again, everyone. We'll see you next week. Don't forget to register for the expo if you haven't already. Thanks again.